My name is Paul Van Sicklen, and today I'm going to talk about 10 applications that all finance professionals need in their visual analytics platform. I've put together a finance toolkit built on ClickSense, and we're going to walk through those 10 particular applications. To start out though, I'm going to start with a story. If you were about to build a house and a contractor showed up with the tools that he's going to use to build the house, but the second contractor then showed up and he actually showed you a portfolio of his houses that he's built, which contractor would you think you'd go with? But take it a step further. Make sure that you look beyond the pretty pictures. Pick that solution that has plenty of horsepower in the garage of that house that you're going to build. Search, governance, scalability, mobility, collaboration, and as important as anything else, speed. This particular use case is very well documented, and I spoke with Jeff from McAfee several years ago, and his story is very similar to mine. The capabilities of Click has brought the finance department, financial planning and analysis department, a tremendous amount of value, and that value has been then extended to the rest of the organization. Go to click.com and search on McAfee, and you can find out plenty more about this particular use case. I'm going to jump right into a demo. This particular demo is a straight expense analysis. I have my source of Essbase, Hyperion Essbase, and the data has been extracted through a Click connector and displayed now in this particular PowerPoint-like presentation or storytelling feature of ClickSense. And what I see is that in my expenses I have depreciation. Depreciation is one of those things that you often strip out of your expense analysis so you can see operating expenses, which would be expenses before depreciation and amortization. So let's go into the dashboard itself, find that depreciation, and strip it out because I want to see operating expenses. So here we are now in an introduction to the associative model, and what Click brings is the ability to make any selections on your data and not have to require any more janitorial spreadsheet work. For example, I can look at the first couple quarters of 2014, and I could go into expense type or a product level type and consolidate and aggregate 3 different types of products. And maybe I just want to look at 1 or 2 different types of expense line items as opposed to the entire set. And just like that, you can see that I've actually been able to come up with a very customized expense analysis. And this is all made possible through what we call Click's associative model. In the old school query technology that most every other technology uses out there, you have to do a predefined drill path, and that predefined drill path puts people in a box, and you're not able to then get out of that box and see other associations with your data. In financial services, it's combining match rate costs of funds. It's combining expense activity-based expense cost analysis. It's combining capital allocations, and it's combining that entire income statement and balance sheet equation for risk-reward trade-off. I'm going to clear all this, and I'm going to go to the next page, which is a page that if I were looking at my expenses, this is the type of dashboard I would set up. This is a straight, very basic actuals versus forecasts and a favorable or unfavorable view. And again, I have the capability of selecting a particular year or a group of quarters, and I can dive into a specific product or combine that with multiple products. And I do not have a predefined drill path. I can ask and answer virtually any question that comes. In this particular case, maybe I want to drill into 2 or 3 specific cost centers, and I have my analysis. So I'm going to clear all this. I'm going to go to the next tab, and I'm going to actually navigate the tab through here. We're actually going to walk through several more tabs of analysis. And I'm going to start with the stock price analysis. In this particular case, there's an HTML table that's available out on NASDAQ. And what I want to do is I want to take this data, bring it into Click, and I want to analyze it in my own particular customized way. So I've done this, and it's been very simple. I can go in here and capture Click, hit the reload button, and what's happening now is it is going out to the NASDAQ website. It's capturing the table, and in fact, it took a little bit longer than normal because, in fact, I've actually reloading a couple other data sets into the same application. So I see the Click stock price over the last few weeks. What's interesting, maybe interesting to me, is that I see that there's been a pretty good run over this time period. I may actually want to drive into it and say, show me the 34th through 36th week of the year, and I can dive in and see the analysis and what's going on with the stock price. So I'm going to now go and navigate to the foreign currency translation page. In this particular case, I have a balance of a set of data that I brought in, which is a period end balance of my portfolio, my balance sheet, over several years, back to 2010. And what I've done is I've actually gone out and utilized Click Data Market, and captured currency rates back to over that same period, and automatically merged that data with my balance data to give me an exchange rate for each one of those periods, and then I'm able to convert my numbers from US dollars to euros in this particular case. Click Data Market has a very wide range of currency translations available, and more information can be found on click.com. I'm going to go to the next one, which is a cash flow valuation. This is a very typical spreadsheet that I've seen in my past finance life. Essentially, we're talking about hundreds of individual investments. They could be loans, they could be leases, they could be equipment, and tied to each one of those is a cash flow. The column F is actually the cash flow of what I may pay for that particular loan, and then the columns G is the actual cash flows that I expect. And my goal here is to actually capture the valuation, or the internal rate of return, of all of these cash flows and be able to explore them in different aggregations. If I were to want to do that with Excel, I would break out each one of the aggregations into a separate tab so I can quickly navigate each one of these. But this is very time consuming and opens myself up to many different Excel spreadsheet errors, and that has been well documented in the past. So what I've done is, instead, I've taken this table and I've brought it into ClickSense, and I've calculated one formula to calculate the IRR, and this formula is in the Govern library, and I've reused these formulas into each of these objects. And it allows me to do is go in and say, if I want to look at the West portfolio only, I have an IRR of that portfolio of 92 investments for 5.99%. But what if I wanted to combine the West with Central? I've got 598, and maybe I just want to look at the real estate portfolio only. And I can see, as I open up this view here, that I've actually got 46 investments with an IRR of 589. And at any point, I can actually flip it over and look at every single one of those investments. In this particular case, I don't have a lot of creativity in the amount of the investment itself, but I do have some variation in the actual rates. Drilling to detail, bringing all the detail in, allows me to go through this and cycle through any view of the data that I choose. Let's go to the compound annual growth rate calculation. In this particular case, I started out with a spreadsheet of 32 business units, 30 plus business units, and two major divisions, a commercial and consumer division of a bank. And these are quarterly balance, month-end balances back to 2007. Now, I cannot make heads or tails of this spreadsheet. It is not useful to me as it stands unless I am intimately familiar with these numbers. So what I've done is I've actually taken these numbers into ClickSense, and I'm analyzing the current month-end balance, which is 352 million, and the compound annual growth rate of 16% over this entire time frame, and this is actually the trend being shown. And what you notice right away is when I have a portfolio made up of 30 business units, I have some business units that are growing at a significant amount, but I also have some business units that appear to be divesting or just running off. That's really important information because I may want to look at just my top 5 or 10 core portfolios. In this case, I picked 9 core portfolios, and I can see what's growing and what percentage they're growing at. But maybe more interesting than this is that this entire compounding annual growth rate calculation is being tied to the actual time, and it's a time value of money calculation. So it may be more relevant for me to look at the last 5 quarters of growth as opposed to the last 7 years. Immediately when I see that 5 quarters of growth, all of a sudden I see something pop out that's really, really important, and that is my two of my largest business units are actually not growing, but they're shrinking. And I can scan through here and I can actually take a look at them and see. Now they're not shrinking by a lot, but they are a significant drag on the growth rate of the entire portfolio. When I worked in pricing at a large bank in the US, we had a saying that if you could model a single loan, then you could model an entire portfolio. So we would spend a lot of time on that single loan model and make sure that it worked properly. Now this one's very basic. I'm simply forecasting the balance, the ending balance or the ending AUM, and I'm forecasting the interest income for that particular loan. And so again, it's just a matter of changing some assumptions. And what this shows is that Click is very good at the forecasting capabilities as well. So as I make these changes and these what ifs, the portfolio automatically changes. So I mentioned that this is a single loan model. What happens if you make this a whole portfolio of loans and how it amortizes down to 0? This could easily be then taken to a new level by integrating a new business volume for every month and combine it with an existing portfolio to watch the entire portfolio and how it performs over time. In this particular chart, I'm showing a break-even analysis. I take a simple assumption of 5,000 units sold, and I create the profit equation to calculate total profit. That 5,000 is put out on 20 points, but with different units sold wrapped around it. Some going down to 4,000 all the way up to 7,250. I do all this just to create these 20 points in this line, and then the break-even calculation is a simple calculation. It's fixed cost divided by price per unit minus variable cost per unit. Now this is pretty basic and it's not particularly exciting, but when you actually take a look at what we're going to do next, it starts to get really interesting. In this particular case, I took the Black-Scholes model the Black-Scholes function within the Click engine. And it's important to note that all of these functions can be used in visualizations themselves, as I'm showing here, calculated on the fly in memory, or they could actually be run in the script, and you could actually capture these numbers in a QVD file and reload it into the script. But in this particular case, I've got 1, 2, 3, 4, 5, 6, 7 assumptions that go into the Black-Scholes model, including strike, the expiration, the underlying price, volatility, risk-free rate of turn, whether it's a call or a put. You can make changes to this and it'll actually change the numbers automatically. You could say it's more likely that my option is going to expire in 3 months, and the chart automatically adjusts. In this particular case, you could actually flip it on its side and analyze what the put looks like or the pricing of the call option. Let's take the combination of the total profit equation and the ability to handle complex mathematics and see what happens when I actually turn this into a simulation exercise. In this particular case, I've got a single assumption called price of $118. I'm going to put that price out on a normal curve with a standard deviation of 2 1,000 times. So essentially I'm creating a Monte Carlo simulation simply on price. Now this can be done on many other assumptions, but I'm simply focusing on price at this point. And when I focus on price with that standard deviation, put it out 1,000 times, this chart and this table are calculated automatically. These are 4 calculations that are going into this chart. So if you take the 1,000 simulations times 4 calculations, there's about 4,000 calculations being done on the fly in memory. What happens if I make it 40,000 calculations? What happens if I make it 400,000 calculations? And just for fun, let's run 4 million calculations or 1 million simulations. I'm running this on my Hewlett-Packard laptop, 16 gigabytes of memory, nothing too special here. And it all happens pretty quick. I'm going to pop this open, take a look at this chart, and I can actually zoom in and see the distribution of the results. If I wanted to dive even deeper, you can see here where I am on the chart. I can dive even deeper. It shows me the points. If something in particular is interesting to me, then I can actually make the selection and analyze just that set of data. So that's my presentation today on why you should get your finance person involved in your visual analytics platform. These are great use cases that can be applied to many different business problems in finance and accounting.